Once again, come back to the risk and return. And we are talking about the uh, portfolio return and risk. Now we have completed risk and return. Let's talk about diversification and some of the theories prevalent in the field of finance. What is diversification or diversification? It is just, a strategy to spread the risk, right, among the available options. Let's say instead of putting your entire investment in one security, you try to identify 3 4 securities or whatever is possible for you from the market and put your money in different baskets, right? If something goes wrong with a particular security, then you can withstand the loss out of that with other security when you are going for portfolio. But if you are investing all your money in one stock, if that stock is not performing, your hard-earned money is lost. Look at this, even in the field of merchandise or trade and commerce, people go for diversification. We are talking about financial assets. Even if you look at the real assets, people go for diversification. When we were small children, we know an English news daily called uh, News Time. News Time is the English version of Enadu Telugu newspaper, right? For some time it was doing okay, because Enadu was successful. They started another version, English version. Then it didn't do well. Then likewise, Soma soft drinks was one of the products, and it was not able to compete with the other soft drinks available in those days. So there's a successful newspaper, Enadu, but there's a failure News Time, and there is a successful product called Priya Pickles, but there's a failure of Soma soft drinks, right? And for a quite long time, the film city of Ramoji Film City, it was also not doing well, but it took nearly a decade to consolidate itself, its position, and withstand all the financial, chaos, right? So people go for diversification to hedge against the risk. So therefore, we go for different combination of the financial assets. I'm not talking about the physical assets, but the financial assets. So diversified portfolio at least should consist of securities which are not, perfectly positively correlated. Please bear that in mind. Now, I mean to say the stock should not go hand in hand. What is that? If one stock is going in one direction, or let's say upward direction, the other stock also is going according to that direction, then you're at risk. Your stocks or your investment is at risk. It is because the stock that goes up may also comes down. When it comes down, your other stock also comes down. So therefore, don't select stocks which are perfectly positively correlated. Another logic or principle that you should bear in mind is a portfolio should contain some high risk and some low risk securities, a combination. Okay, in marital relations, God always, he creates, he unites the people, the man and woman as couple. If the husband is too fast, too energetic, the wife is conventional and goes with the slow pace. If the husband is spendthrift, the wife is conservative in spending, or if the wife is spendthrift, the husband is conservative. Look at this. They don't go hand in hand. They're, it appears there's a perfect mismatch, but no, they are not positively correlated, which is good for the family. Let's say if both of them are spendthrift, now they'll become bankrupt in no time. Let's say if both of them are conservative and very stingy, and not able to take out bucks even for their most essential needs, then the family cannot survive, right? So therefore, a combination of these two, how much risk reduction is to what extent we can minimize the risk, how many different securities are required for me to minimize this risk factor is what the question that you should ponder over in your mind. So for a company, a portfolio containing 20 to 25 securities would be risk-free. For an individual, if you are an individual investor, so a portfolio of at least 7 or different securities considered good. Yeah, when I invest, I also used to invest, you know, 2 or 3 stocks, but that's a wrong way of investing. At least 7 different securities are considered good. Okay, right? You can minimize the risk. Okay, but what are the kinds of risks, types of risk that you see for your securities? There's a systemic risk or systematic risk. Earlier also, I was talking about systematic risk and unsystematic risk. Systematic risk and unsystematic risk. What is systematic risk? This is a risk which affects overall, this affects this effect comes from the overall market fluctuations. The economic position, it results out of tax reforms, in a market as a whole. Okay, so the change in the world energy situation or any of the economic factors may cause, it may cause you to lose money in the market, right? Now, one small ripple, one small mistake happened in one small simple mistake happened in the US. It is not mistake; it's rather negligence. And that small negligence, what is that? Ruthlessly, they started lending money to anybody and everybody who comes to apply for the banks. The mortgage loans are sanctioned. What is that? Home loans are sanctioned without checking their credibility. As a result, all of them or most of them have become bankrupt, unable to pay the EMIs. And when you had to recoup money, there's no money with the the customers. Finally, you had to take over the homes. Now, who are the customers who will buy these homes that you have taken over? You had to auction. When it is auction, there's no taker for the auction that you have announced. As a result, what happened? All the money that they have invested all over the world in different markets, they have withdrawn. Let's say from Bombay Stock Exchange, they have invested in 150 or 160 companies. So they have withdrawn that money, okay, withdrawn that money through their FIs, foreign institutional investors. Now, it is like this. When there's a problem there, they have, that's a fixed deposit they have deposited with a mutual fund, and that money is kept here. When an investor who has invested in mutual fund in the United States withdraws money, what happens? That company withdraws money which it has invested in the Indian market through Bombay Stock Exchange in companies. So when one customer does, and along with many other customers across the country did it, the whole money is siphoned out of the Indian market. When it happened, the stock market just collapsed, and all your stocks, which were trading at 1200, 1300, 1500 have come down to 50% low, 600, 700 it became. So look at it. This is what I'm just telling you. There's a risk that you had to face, which is not in your hand, which is not in your control, right? This is systematic risk. Systematic risk is the one that affects the overall market, not just you alone. You are not responsible for it. It is not your fault that you're facing this risk and you don't have any control over this, right? But this is arising out of market conditions. One of the factors in the market may cause this risk, right? A policy decision taken by the government may change the entire scenario, due to which your stocks may behave, anyway, right? So look at this. What happened in Sri Lanka may affect your stocks. What happened in the Saudi Arabia can affect your stocks. This is systematic risk. It is not in your control. Let's come to unsystemic risk or unsystematic risk. Now, this is independent of economic or political or any other macroeconomic factor. It is associated with a particular industry. It is associated with a particular company. Yeah, let's say, Satyam debacle. When Satyam debacle, was witnessed by the market, it was related to only Satyam computers. Now it is Tech Mahindra. It was related to only Satyam computers, industry or IT specific. Now it is even more company specific. That means somebody, for somebody's error, somebody's misconduct caused this risk to take place, right? It is nothing to do with economy. It is nothing to do any of the factors in the economy. It is, because of your negligence. It is because of your ulterior motives. This particular risk is caused. Ketan Parekh, Harshad Mehta's, whatever they do may affect the entire industry, but certain, entire industry. Let's say even those people, if they're choosing targeting only a particular industry, then you may attribute it as, you may call it unsystemic risk. Okay. So I just want you to know that unsystemic risk is pertaining to company, at the most industry. So therefore, the investor can only reduce unsystemic risk because it is in his hand. It is the company's decision. The company's decision can be changed. It is the company's policy. Company policy can be changed. That is in your hand. So whatever is in your hand, you can take a call. How? You can diversify your portfolio. When there is a company specific, when so a company is not doing well, you can take out money from there when you suspect something going wrong with that company and invest in other companies' stock. This is your unsystemic risk hedging, please don't confuse with it. This is not hedging, because hedging is taking a counteraction to a possible risk. So this is avoidance of the risk. You can avoid the unsystemic risk because it is company specific. But systemic risk or systematic risk you cannot avoid, right? So unsystemic risk, systematic risk. Systematic risk, whether you change the composition, whatever be the composition, unsystemic risk, you don't have any choice. You have to suffer, right? But whereas with the diversification, changing the combination of stocks in your basket, the unsystemic risk can be changed. So since you as an investor can take systemic risk, okay, and you should be compensated for that. What is it? Compensation? The return. Okay, the degree, the quantum of return is based on the degree of your diversification. Okay, degree of diversification, right? Now, in this context, we'll talk about capital asset pricing model. Let's look at CAPM, capital asset pricing model. Okay, CAPM is developed by William Sharpe in 1960s. Okay, and he says the relationship between the expected return, the systematic return, and the valuation of securities. It is a relationship between expected return, systemic return, and value of the security. The value of the security, in other words, depends on your expected return and your beta. Systematic risk is denoted with beta. Look at the equation, what I have explained to you. Sharpe gave this equation. Okay, the return on a stock or a portfolio of stock should be equal to its cost of capital. Okay, what is that? Required rate of return on the security. So the required rate of return on the security is the risk-free rate plus the risk premium multiplied with its beta, which is unsystemic risk. Okay, so beta is systemic risk. Beta is systemic risk. Sorry, beta is systemic risk. Okay, now let's come again. Return is equal to RF. What is RF? Risk-free rate. What? You take your money and put it in government bonds, no risk at all. You get little revenue, little yield, an interest. Let's say that interest is 5%. RF is 5% plus RM. Okay, if you're keeping this in a stock market, it gives you 10% return, but that is very risky. The stock may go up or come down. It may go up to 15 or 20. It may come down to 7 or 4. That's a market security. There's no guarantee. But this 5%, which you are guaranteed by the bond, by the government, you will get it. Even if things go wrong, the government still guarantees you to pay that 5% on your bond. So RF is a risk-free return plus the return on the risky security is RM. Okay, expected market return means if you keep this money in the market, your money is at risk, but you get 10%. Right? And risk-free rate already I told you. Now, the difference between risky return and risk-free return is known as risk premium. Look at this. The RM is market return and RF is the risk-free rate. The difference between these two is known as risk premium. You're paid 10% over and above the risk-free rate, that is 5%. Over and above that is, 10 minus 5 is 5. 5% is risk premium. What is that? It's a compensation for taking risk of investing in a security in the capital markets, right? So a minimum that I get is 5% plus, this is without taking any risk, simply saying monthly getting, right? So risk-free rate 5% plus a risk premium of 5%. This risk premium is multiplied with the systemic risk beta. It is multiplied with, it is multiplied with systemic risk beta. So let's say if this beta is 0.5 or 50%, then what happens? So 5 multiplied with 0.5 gives you 2.5. 2.5 plus risk-free rate gives you return. Okay, so R is equal to RF plus RM minus RF multiplied with systemic risk called beta. Okay, so 7.5% is your return. risk-free rate of 5 plus risk premium of 5 multiplied with its beta, it comes to 2.5. So 2.5 plus 5, 7.5 is your return. This is your return. Okay, let's go to characteristic line. You know, it's a regression line. It shows the relationship between an individual security returns and returns on the portfolio. So for drawing this line, you must find the returns that an investor gets in excess of the risk-free rate. The excess return is known as risk premium. So you must know the risk premium. Okay. So look at this. You know, if you're taking years 1 to 10, excess returns on stock ABC. 5, 5, minus 5, minus 5, 2, 0, 2, minus 1, minus 2, 4. Excess return on market for portfolio. 5, 10, minus 6, minus 10, 2, 3, minus 3, sorry, 7, minus 1, minus 8, 0. Right? And the years continue till 20, 11, 12, 13, 14, 15, up to 20 years. And the corresponding excess returns also are given, and excess return on market portfolio also is given. Look at this, excess return on stock ABC, excess return on market portfolio. You know, this is excess return on stock, single stock, and this is excess return on portfolio, market portfolio. So when you know, just plot it in the graph, it looks like this, you know, some are negative, right? Some are positive, and you get a regression line like this. Okay. Then let's talk about the beta, which is systemic risk. The slope of this beta, okay, beta is the characteristic line, okay. Then beta represents the systemic risk, as I told you. This measures the change in excess of returns on the stock over changes in the excess return on the market portfolio, right? You know, the individual excess return, how they contribute to portfolios or baskets of excess returns. That's what the meaning of that particular sentence. I have flashed it to you. Let's talk about beta is equal. You know what these mean. If it is 1, what does it mean? If it is equal to, what does it mean? If it is greater than 1, what does it mean? If it is less than 1, what does it mean? Let's say if beta is equal to 1, the risk associated with the individual stock, okay, it is same as risk associated with the market portfolio. There is no difference between market portfolio risk and the individual stocks risk. Okay, if beta is greater than 1, then the stock has more unavoidable risk as compared to the market as a whole. This kind of stock is generally an aggressive, you know, you're an aggressive investor. Very often people are known as, so people are called by nickname, you know, he's an aggressive investor. It's the talk among the, you know, active investors or the stockbrokers. He's an aggressive investor. You know, he's not scared of any market situation. He takes risk and he also makes money. So yeah, what is that? It is unavoidable as compared to the market risk. You know, this stock has more unavoidable risk. More unavoidable risk. Unavoidable is systemic risk. Unavoidable also is known as beta, denoted with beta. Fine, let's come back to beta. If it is less than 1, the stock is less risky as compared to the stocks in the market portfolio. Okay, it's less risky. Beta is less than 1. And this, you know, people engaging themselves in this kind of stocks they are defensive investors, and the investment is defensive investment. He plays a safe player, you know, he doesn't take any risk. Okay, whatever I get is enough, okay for me. I'm not too greedy. I'm not too enthusiastic with regard to making money from the market. So he's a defensive investor, right? Now we'll come back to the equation. R is equal to RF plus RM minus RF multiplied with its beta. What is this? CAPM again, capital asset pricing model proposed by or given by Sharpe, William Sharpe, the man known for security analysis, right? For that, for this simple equation, these people were nominated for Nobel Prize in economics. In those days, it is economics, even though now we study it as finance, right? Even Morgan and Miller. So even those people got a Nobel Prize for their hypothesis, hypothesis, right, in economics, not in finance. Now this is separated as a separate discipline as finance. Now, suppose the risk-free rate of your security is 6%. We'll take an illustration. And the market rate, if you're investing the same money in the market, it gives you 12% and its beta is 1.25. Then the required rate of return for the security would be 6 plus 12 minus 6 multiplied with 1.25. Just this is the equation, right? This is the equation. 6, RF is 6 plus RM is 12 minus RF is again 6. 12 minus 6, 6. Okay, multiply with the beta, which is 1.25, and add it to 6, which is risk-free rate. That gives you 13.5%. Okay. Now you can also look at one more example. If beta is equal to 1.6, then what is, all other things remain constant. Your risk-free rate is 6%. And your market risk or market return also is market rate also is 12%. 6% risk-free rate, market rate 12%. Only thing changed is your beta. Beta changed from 1.25 to 1.6. What happened? 15.6%. What is that you see? What is that you see? We see greater the value of beta, greater the systematic risk. And in turn, the greater also is your required rate of return. Yeah, that's what, there's a greater risk, bigger beta means bigger risk. But there are also bigger returns, right? The required rate of return is 15.6 when the beta rose from 1.25 to 1.60. So please conclude this way. Bigger the beta, greater the systematic risk, and also greater the required rate of return. You got a return of 15.6. While, when the beta was 1.25, it was only 13.5. Okay. So security market line, you may have, or you may come across a short question on this. Security market line, it explains the linearity between the expected return and systemic risk measured by its beta, right? It's once again, it describes the linear relationship between the expected return and systemic risk measured by its beta. This is security market line. You're plotting beta on the x-axis and risk-free rate on the y-axis, and also returns are there. So the security market line is moving upward from left to right, starting from risk-free rate. Let's say in our previous problem, risk-free rate was 6%. You look at this, right? What if the expected and required rate of return are not the same? You may come across a situation where there is, if the expected and required rate of return are not the same, then there is disequilibrium, right? Now, you will come across, you'll be surprised rather to see that there are certain stocks underpriced and certain stocks overpriced. Whichever stock has a higher beta, okay, is underpriced. Okay, whichever stock has lesser beta is overpriced, right? So the returns are very high. Okay, look at this. There is a security market line which starts from 6, let's say. The returns are plotted on y-axis, right? Let's say if you're plotting 1, 2, 3, 4, 5, 6, 7, 8 up to 10 on y-axis, let's say this SML, security market line, is starting from 6. On the, along with this line, if there are some stocks falling above this line, they are underpriced stocks. Below this, they are overpriced stocks. The yellows are underpriced and the greens are, overpriced stocks. Right. So that's it for the day. If there are any questions, please feel free to shoot it to me right on the chat box. So thank you for the time.